A very good morning to everyone.
Very good morning, ma'am.
Thank you, Khusbu, for accepting our invite to be the speaker for today's session. It gives me immense pleasure that our own BVA members are volunteering to speak on this forum. I take pride that Khusbu is our BVA member. Thank you, Khusbu. We always welcome our BVA members to come forward and speak on this forum. It's my privilege to introduce today's speaker, Ms. Khusbu Agrawal. She is a practicing company secretary, registered valuer, independent director, and social auditor. She also has done masters in commerce and masters in journalism, mass communication, and LLB. She has over 7 years plus experience. She is also a fitness freak and being a dedicated marathon runner. As a company secretary, she handles all complex cases like NCLT proceedings in operation, mismanagement, investigation, etc. She handles secretarial audits, capital market audits. She also is expert in mergers, demergers, and other corporate structuring schemes and arrangements. She also has great insights in NBFC compliances, CIC registration. With respect to valuation, she has done various valuations under IBC code, SEBI regulations, private placement, angel funding, preferential allotment, transfer of shares, mergers, and acquisition. She is also empaneled as a registered valuer with Metropolitan Stock Exchange of India. Welcome, Khusbu, for BVA today's session. Over to you.
Thank you very much, ma'am. And very good morning to all of you. We are sitting in the last weekend of Holi. So happy Holi also. Well,
Good
ma'am,
morning,
I
everyone.
want to share my screen.
Yeah, you can share your screen.
Okay. Today we are here to discuss about very unique topic, I must say, about this startup valuation from strategic investors perspective. So let's learn about this thing. So first of all, what makes it startups? Are startups same as we see like normal companies, or startups are any different? Let's find out that. So when there comes a startup, it must come with a unique idea. So the start, as if you say, it starts with a company that needs to grow fast. It is not that the company will have a steady growth, will have a the startups who want to start a startup, they have thing in mind. The startup will grow very fast. Like if you say barber shop will not grow that fast as that of a startup. So startup concept is very unique in nature than the regular companies. Other than that, startup, as we say, all the startups are in technology field. No, it is not the case. The startups are not to mandatory work on technology. A list of simple ideas also can make a successful startups. Startups is all about finding an idea on everyone's where there no one, nobody has seen the thing, so there is a blind spot. The solutions were always there in the market, but there is a startups who is coming with the idea. If you say Ola, Uber, the concept was there. We used to hire one taxi and go, and commuting was made very easy with these startups like Ola and Uber. So startups also come with innovation, simple things which we used to do earlier. It will be done in an easier way with an innovative technology. So startups make something people always want. So there is a need for a particular thing. Then the startups come with an idea to give us a holistic approach and to provide a solution to that problem through a unique way. So in startups what they basically do, they reach out and serve those people. So a barber shop is also solves people. Someone like if we have a if you want to haircut and do other things, barber shop was already there. It is traditional thing with, but with the new startups, things like the urban clap, they have a idea that we can book the salon at our home, and from the comfort of our home we can take the salon services. So startups are also good at technology. They also face the problem, but that can be solved. So how Apple was started? There was Steve Wozniak. He wanted to have a personal computer. So he was sitting and he knows how to make that one. So Apple was formed. The same thing happened with Google also. Google was founded by Larry Page and Sergey Brin. They wanted to have a search engine, so they have conceived that idea. And to improve the search engine, how this Google was formed. So this is overall idea to what makes a startup. Government of India is also coming up very startup friendly investment schemes. Startup, they have also provide the tax exemption to startups. So startups are talk of the town these days. So what are the common characteristics? If we say what makes a startup, so they have certain common characteristics any startups has. So they have innovating thing, like I was discussing, problem solving. They always want to fast growing, scalable. Once if you invest in a startup, it will give a growth boosting things. So it is scalable, it is flexible. They diversify the things as per the environment, business environment. Yes, they have a higher risk. They have a strong company culture. They're always young in age, like the startup founders, whoever you must see, they are all coming like IIT, IIMs, and they are very young in nature. So they were smaller teams also, because the persons, those who start, they start their own. So that team is smaller in numbers. They are tech oriented and often funded by outside investors. When it comes to startups, you also have seen Shark Tanks, where the investors come and invest in their ideas. How much startups fundraised by Indian startups? If you see, in up to the 2023, Indian startups had raised over 141 billion from 2014 to H1 of the 2023. This figure is high. While in 2014, we have only reached just 377. Up to that, it has dropped in slight in 2023, but the graph is going up down. Then it has come to peak in 2021. After that, it is slightly reduced. There is a common element in, if you see all the startups investments. So if you see the names, there are big startups names we can see in the screen. Flipkart, Byju's, Ola, Renew, Swiggy, Zomato. These are very famous startups, but the common element, they have some notable investors behind them. If you see the funding amount of Flipkart, $12.9 billion. Among that, SoftBank, Tiger Global, SL, Walmart. So in all the startups, you can see there are some common elements, like SoftBank is there in most of the startups. Tiger Global is there. General Atlantic is also there. So there are common elements in each startups. Some investors are there who are always looking for startups good. They have a good idea in mind, so they invest in that kind of startups. If you see, startups come, when a startup, they have to go through 3 stages. When some startups are incorporated, they are mostly bootstrapped. So the investors come at a later stage. The founders who build the startup, they have their own funds, and they with that they bootstrap the startups, and startups come to a final stage, first stage. So there are 3 stages in, if you say, for startups go. There is a pre-revenue stage, when the startups doesn't have the revenue, they have the idea, they are growing, so they are in the pre-revenue stage. At this stage, there is virtually no or negligible revenue. Operations may have commenced, or sometimes it doesn't
Khushbu,
commence. Yes, ma'am.
since all of this is we are aware of it, you can jump this and go to the actual points.
Okay, okay, ma'am. So I'm just brushing up for 5 minutes more on different
Yeah, yeah,
strategies.
yeah, yeah.
Yes, ma'am.
Yes.
So pre-revenue startup, revenue generation startups, then they have commenced the revenue, then the post-revenue stage comes. So methods of valuation, we know traditional methods and modern methods. In traditional methods, we know discounted cash flow, comparable company transaction, replacement costs. But in startups, I am not going too deep into this. So modern methods of valuation in startups. These modern valuation methods are used: venture capital method, first Chicago method, scorecard, Burkus. I will just go through it. I'm coming to the pricing of startup thing. So if you see from investors' point of view, there are three kinds of investors in case of startups. There are strategic investors, there are financial investors, there are corporate investors.
Khushbu, sorry to interrupt you.
Yes,
Those
ma'am.
methods, I think, were good. You
I
can.
will go one by one, ma'am.
Okay.
In between, I will discuss.
Yes,
Yes.
yes.
So if you see from the strategic investors point of view, strategic investors are those persons who are experts in their own field, and if they go to invest in a startup, they don't have financial returns in their mind. They can be an individual or organization that contribute capital in the company with the point of accomplishing certain objective other than the monetary benefits. So the strategic investors, they have a thing in mind. They want to grow the startups they acquire. They don't have this financial returns on mind always. They work on revenue multiples, EBITDA. They go on that. So not at all like money related speculators who frequently seek after pay. Vital investors frequently give included esteem to companies through trade insight, commerce information, workforce assets, innovation, or collaboration. So such investors include, those are the strategic investors: corporations, investment firms, private equity firms, wealthy individuals with special wealth or expertise in the business they invest.
Khushbu, let me know when to launch the first question of the poll.
Yes, ma'am. Just a second. From the investor's point of view, if you see, investing in startup has become the foundation of many business and companies' growth plans. While considering investment in new ventures, many factors guide them. These incentives may include access to new technology, expansion into new markets, increased business competition, ecosystem growth, financial diversification. When the strategic investors want to invest, they see these factors out of. Some may invest to grow their business technology. Some want to expand into new market, like Tata Consumers has acquired Big Basket, so they want to enter in this. They were always in FMCG segment. Through big basket, they have attracted the grocery market, so they increase their business competition, ecosystem growth. Investors use a variety of strategies to identify and evaluate new business opportunities. These strategies may include finding startup deals, partnering with the accelerators and incubators, participating in venture capital, finding joint ventures and collaborations, and exploring merger and acquisition opportunities. Investing in new ventures offers many benefits and opportunity to investors. Through these strategic investment, the investors get many benefits. These include access to technology, like I was discussing. Sometimes they also acquire this intellectual property. If some brand value is attached, so it multifold their own ecosystem. They enter into a new market or business opportunities. Creating entrepreneurs can use their unique strength. Those investors who are there, they use their unique strength and resources to obtain positions and play a key role in driving the economic change and shaping the future of business. So startup investors always focus on things which are not always monetary benefits. So here we can have our poll questions one. Ma'am, you can float the question, ma'am. Vijay, ma'am.
Yeah, Vijay, can you launch the first poll question?
Yes, ma'am. Yes, ma'am. Sure.
Vijay?
हाँ ma'am.
Can you launch the first poll question?
Yes ma'am.
The question is displayed on the screen, ma'am.
Vijay, shall I?
Ma'am, already launched ma'am.
Please participate all.
I request the participants to answer the poll question, and the CPRs will be granted on the basis of your answering the poll questions. And in case you have not paid for any CEP session separately, so all of the poll answers and replies and attendance and all everything will be deleted for those members, and then only for those who have submitted, who have paid CEP fees, the CEP credit will be given by IPBI.
So it's related to this topic. As how familiar are you with the concept of strategic investments in the context of valuation?
Yeah, you can end the poll and display the
Okay.
results.
The results will declare now, ma'am.
Yeah. Vijay, are you sharing the results?
Yes, I can see it on the screen. So 46% it is saying that they are familiar with it, and 4% are not familiar. Okay, so I think 40-50% are familiar with this thing. Okay, so we participate in interact with me. So we don't sleep in the middle of the session. Let's proceed then.
You have to reshare your screen.
Yes.
While the poll is on, you can keep your screen sharing, Khusbu. This poll
Okay.
automatically we can do.
Okay, ma'am. So this strategic investors I was saying about. So now how the startups are priced. When you value young companies, that comes with a purpose. The most common pushback that will get is the value, that is whatever people perceive it to be, and young companies can therefore have any value that investors will sustain. In Shark Tanks, if you see the startups who comes, they come with a valuation. They ask the sharks that we have that much of valuation according to our own perspective. They value their own company as per their own factors, if you say, and upon that they ask the sharks for the shares. So it, for young companies, they have a what people perceive about it, so investors, the value it will sustain for them. So this, there is a distortion of word value. It is true that young companies are more likely to be priced than value. So there is a difference between pricing and valuation here. Price, as per Professor Aswath Damodaran, the pricing will be based upon a simple pricing matrices, anything from PE to EV sales multiples, and what investors perceive to the peer group. We always look for the peer group pricing when we see the valuation, or when we do the valuation, we look for the EV by EBITDA multiples or peer group multiples. So pricing will always be based upon the simple pricing matrices of the peer group and what investor perceive for the peer group. There are several drivers which drive the pricing thing. So to determine a value of the startup, can feel like pricing a number out of a hat. So there is a hat, there are different numbers. So it's like we have to pick out one number from the hat. So it depends upon these drivers: availability of capital. There is higher liquidity in the market, which is higher than the larger number of buyers, higher valuations, and vice versa. Startups are mostly, they come with a higher valuations. Valuation numbers are derived from their own perspective, what they think about the future. As we see in the discounted cash flow methodology also, the prices, we discount back the projections done by the startups. So they have a thing in mind, they will grow 10, 20, 50% in the coming years. So sometimes they have a higher valuation in mind, and they have projected the company as very they project the company in very growth like 10, 20, not they projected 100%. In the second year we will go 400%, 500%. In that case, the higher valuation matrices come. Second thing is value versus price. Value is not determined by those who set the price, but value is determined by those who choose to pay. When any investor invests, he has to see the prices are actual and valuations. He can feel it should be the valuation. It depends upon these factors. So scalability also come how much they can scale the business. If the business is in early stage, how the scale will be high. The bigger the market you are entering, the bigger the valuation, the more attractive the startup investments. And fourth point is investors' right. Higher valuation come with aggressive demands. If there is a higher valuation, it will come with aggressive demands. These are four drivers which drive the pricing. Okay. What are the factors that impact pricing? If you say for impact wise, there is availability of capital. As we have, if we discuss the SoftBank portfolio allocation in March 2021, Alibaba was holding 42%, followed by SBF 1, 2, Atom funds, and SoftBank part was only 7%. But in March 2023, if you see increasing allocation to SoftBank Vision funds, it raised to 24% to 40% for investment in startups and tech companies. So they have increased their allocation here also 7%, then to 15%. So they have a more availability of capital. So they increase their allocation. Value versus price. As we know that there is a difference between value and pricing. Pricing comes from an asset. Like in stock market, we see the markets. In market, the price of a share is determined by the demand and supply with all the factors, rational, irrational, behavior that go with the process. So here when we do in market, the valuation is from the trader perspective. What the trader is ready to pay, what is the demand and supply. But in valuation, if you say valuation is an attempt to attach a value to an asset based upon its fundamentals. When we value a company, we see the fundamentals, how strong is the cash flow, how strong is the growth, risk. So it is done from the investor's mindset. When we are doing the valuation from the strategic investors point of view, we have to see these fundamentals which are lying in the company, whether the company has sufficient cash flow in the past, whether it has the potential to grow, whether it can bear the risk. So the valuation will depend upon the fundamentals. Startups are priced mostly from the pricing perspective. A typical investor in a startup company think as a trader and price it accordingly. If you see a typical investors means venture capitalists. Venture capitalists always see the startups as from a financial return point of view. They will invest in a startups. They have a short-term horizon. We were discussing about the types of investors, strategic investors, and the venture capitalists. These are corporate investors, and that in the type of startups, it is called financial investors. They always look upon the financial returns. They will invest for a certain period of time. They have a thing in mind ki if they acquire 20, say 50% return, they will exit from the startup. So typical startup think as a trader, not as a the valuation point of view. So when we value the startups, what are the right startup pricing technology we must keep in mind? So finding the right pricing policy is the key to success of any startup. It not only determines the revenue and profitability of business, but also plays an important role in market understanding of the product or service. It is important to understand your target market and customers before creating a pricing strategy. If the startup is creating, they have given us the projection, they must have thought about this, who are their target market, who are their customers. They do the market research and they have a deeper understanding of their industry, competitors, and customer preference. And the strategic investors also have, when they are acquiring a startup, they have a thing in mind. They are also experts who are experts in their field. Now they are acquiring any other business which have a similar line of business or in which they can grow their own business. So they also identify their target market in which they will venture through these investments. There are some commonly used pricing strategy for startups are cost-based pricing. First is cost-based pricing. In cost-based pricing involves setting prices based on the production cost of your products or service. This method ensures that you cover your expense and achieve a desired profit margin. So cost-based pricing, they focus on their cost to be met and they achieve a certain type of market profit margin. Second is value-based pricing. Value-based pricing, they focus mostly on the how the product is valued and how they can deliver to their customers. This model takes into account the benefits, outcomes, and unique value which is offered by the particular product or service. Then there is competitive based pricing. In that, it involves setting pricing relating to your competitors' offerings. What the competitor are offering, we will also set that price. And this model also requires monitoring, analyzing of pricing strategy of your competitors to ensure you are priced competitively within the market. Then there is penetration pricing. In penetration pricing involves setting initial prices relatively low to attract customers and gain market shares quickly. We have seen when the Uber has come to market, they were giving the rides. Some of the rides were free, some of them were at a discounted price. So it is a example of penetration pricing. When they want to enter any new market, they will keep a very low rate to attract customers, then they can have a big market shares. Then freemium pricing. In freemium pricing is a strategy where the basic version of a product or service is offered for free. In this case, they offer the products for free and with additional features or premium functionality are available also for free. So they like Jio, when they entered the market, they were giving free telecom and free data services. So they were using this freemium pricing technology. These factors are important when we just a second. When we price the startups based upon these factors, our valuations will also differ. We have to find out what the startups, how they have done, how they have made their projection and what is their pricing strategy. Accordingly, we can do their valuation and the factors will depend upon that also. These were the pricing strategy, then the factors which affect the pricing of these startups. There are top 7 factors which influence startup valuation. What is the market potential? What is the revenue and growth trajectory? Team and management quality, product or service uniqueness, competition and market position, scalability, economic and industry conditions. The pricing of startups, unlike typical product, is not simply based on the production cost and desired profit margin. It's a complex equation which considers both internal and external factors. Here is a background. So internal factors we see, there is cost, there is revenue, there is value proposition, and external factors are market conditions, competition, industry standards, customer perceptions. These internal and external factors, they play a major role while pricing the startups. There are also additional considerations. Stages of development. Is there earliest startup which the strategic investor is acquiring? The status of valuation also has a very important role. And there is the funding requirement. The amount of funding a startup seeks can also influence its pricing. Investors will typically expect a higher return on investment for the larger stake in the company. It's always financial investors, they want the maximum returns from the startup. So funding requirement is also a consideration for the pricing of startup.
Khushbu, we will launch the second question now. Okay, it is a general
Yes,
question.
that I was saying.
Yeah, Vijay, please go ahead.
Can I have it on the screen, ma'am?
You can continue to share your screen actually.
Okay. Knowing that, we can proceed with the case studies in which I will explain about.
Khushbu, I also want to have some questions in my mind. Okay,
Yes, ma'am.
it's a very good thing that you have brought out the strategic investor point, because somewhere, sometime, this question has to be asked. Maybe I can say the initial, while I'm having an engagement letter with the client, I have to ask, who is the investor, because the value is different from for a financial investor vis-a-vis a
Obviously,
strategic investor. So I appreciate that you have chosen such a different topic, and there are so many
I was
factors.
explaining about the factors also as well, because when we value the company, we invest time in learning about the company also, why the particular startup has given these things, and why the pricing strategy and these factors which affect the startup pricing will impact our valuation. Until we know the company, we cannot get the multiples from the peer group also and make our adjustments. So it is very essential that strategic investment know about the company in and
And one
out.
more thing, Kushbu, what I
Yes, ma'am.
was thinking while you are stating all the factors is, say, for example, penetrative pricing. So we have a penetrative pricing. So definitely the cash flow, if at all I decide to use the DCF, cash flows are not going to be high because you want to penetrate to the market.
Yes, yes.
So does this mean that I can still use the DCF and extend my valuation? Normally we take 3 year, 5 year. 5 year is a normal valuer's choice.
This
So
comes
if
with
I'm doing
the,
penetrative pricing, no free cash flow, so no value in DCF for 5 years. So do you suggest not to use DCF, or you want to suggest extension of over a period of 5 years?
ma'am, for that we use the modern methods of startups in which many factors are there. I will discuss that now. Modern valuation
Yeah.
methods. Yes,
Vijaya,
ma'am.
are you sharing the results?
Yes, ma'am.
Okay.
77%. Yes, ma'am. The poll was
Kushbu, you can share your screen. That is parallel to the poll.
okay.
Both the windows the participants can see. Poll also, this also. Parallelly, it throws up.
So, so in the startups, modern methodology is their venture. There are four methods in modern methods of valuation. Apart from the cost and income approach, they have given these four methods for valuation of startups: venture capital method, first Chicago, scorecard, and Berkus method. In these methods, the valuation technique is little different. It doesn't depend more on the cash flows, but mostly on the several other factors. First is venture capital or exit multiple method. As the name suggests, it is mostly used for venture capitalists, those who have a thing that they will exit from the company after attaining certain profit percentage after 3, 4, 5 years tenure. So in that case, this venture capital method is used. So this method is used mostly by the venture capitalist who has investment horizon of 3 to 7 years and exit the company when certain milestones are achieved. So in this time, first an exit multiple is estimated based on the post money valuation. When we do the valuation from the DCF method, there is pre money and post money. So we have to estimate an exit multiple, and the exit price takes into account the time and risk associated with the investment. So like we do the post money valuation, we do from the DCF method, we did the terminal value and divided by this expected ROI which the venture capitalist has in mind, or the expected ROI of the investor. If I am a venture capitalist, I want to invest in a startup with a thing to attain my specific objective within 3 to 7 years. So I will find out terminal value, what is come with the DCF and divided by the post money revenue. So this method has some limitations, as of say. I'm not discussing it because we are discussing from the strategic investors point of view. So I will explain about the some case studies in which they have used the methods used by strategic investors. In venture capital method, there is a limitation of anticipation of exit value based on expected financial outcomes or milestone to be achieved in the forecast period is a subjective assumption. Whether I will achieve that particular returns or not, that is subjective. So determination as ROI is another subjective assumption. The valuers mostly works on assumption, and in this method also it is a limitation that the ROI which I want to achieve is an assumption, and it is based on the perceived risk of a given investors and can produce varying result between the investors. It can give a different result also. In first Chicago method is used in the second stage of startup. Second stage was revenue stage. First was pre-revenue stage, second is revenue stage. When the startup has come to the revenue stage, we can use this first Chicago method. Under this method, valuation of startup entity is carrying out using the comparable company multiples. We have to see the comparable company multiples, and this in turn could be based on the existing year financial data or exit year financial data. The company is also in the revenue or is the revenue stage. The company is having the financial data. Based upon that, we can use this first Chicago method. In this, we create a future scenario of the financial forecast at 3 level: optimum, pessimistic, or balanced. We create a scenario. If the company is going good, if the company is in worst case, is the company is the middle state. So balanced mid position is arrived by the valuer after a proper inquiry and due diligence. We have to arrive at this midpoint when the company will not have a best case or the worst case. It will have a balanced state. So in this, we have to determine the terminal value or the disinvestment value at exit for each of the 3 scenarios. Here, market-oriented valuation concept of multipliers are used. It can be seen here that critical part of this exercise is availability of transaction data with respect to peer group. How much the peer groups are available. As we all know, startups mostly have a unique idea, so finding the peer groups is a bit difficult. So we have to make some adjustment if we find some peer group as per our chosen company. So in this case also, we have to determine the required return and calculate valuation of each scenario. In this 3 scenario, what is the valuation, and then estimate the probability of each of the scenario and calculate the weighted sum of the valuations to arrive at the final conclusion.
Here I have a general
Yes,
question. Can you go back to the...
Yes, ma'am.
Say, for example, when I take best case, worst case, and midpoint, okay, all of us are clear that it is more on the revenue element, the top line.
Yes.
Okay. While I am emphasizing that in the top line, normally, what is your experience, the practicality of this, whether costing also is done, profitability is also done on that best case, or is it only the top line? And how about your working capital? Okay, your working capital is going to be the major thing, right? And capex also, maybe I will be, is that changing everywhere, or what are the elements which are changing in the best case, worst case, and midpoint?
Ma'am, if you see in the best case of obviously we have a good profit, we have good revenue, we have less expenses, and we are having good surplus. So
same
in
on
the
balance sheet and working capital also.
In balance sheet, working capital is like that. The sufficient working capital which we require to run the company, it is available with us in the best case. But in the midpoint, we are going break even. Just in the worst case, working capital is negative, so we are not having the funds. If you say, and capital expenditure, if you say capex thing is in the best case, the capex we have done our thing, and we have this good number of assets with us, so no more big capex.
Actually, here there is a catch, Khusbu. Theoretically, yes, I understand.
Yes.
I can relate to this conversation. I agree theoretically, but not practically. Because what happens is, in an optimistic case or a best case, the risk factor I attribute could be more. So even though the value is more, as a valuer, I give it a risk element, the probability element of the best case being the reality, and peg it down. And in a worst case, I give, there is no risk attributed because there's a worst case.
Yes.
And in the midpoint, again, I'll have to evaluate. So don't you think that somewhere more or less as a valuer, the value could be not exactly the same? Best is not the best. and worst is not the worst. Somewhere, because of the valuer's judgment coming in these three scenarios, so what is your practical experience? Because I have actually not done this scenario analysis. So you can enlighten us as to how you have handled or how you have attributed risk factor for this.
Ma'am, as for first Chicago method, I have not used this particular method. I have used other method, Burkers method and all. But if I had to apply in a company which has these three, I can build a scenario like this. I will focus on more on the creating like the valuation cannot be very high or low, but the valuation should be, it is justifiable for the part of the investor also and the startup. If I do this in a practical way, yes, ma'am.
Have you applied Berkas method for by chance RBI FEMA regulations? Is it accepted? Have
No,
you ever
ma'am.
tried?
No, ma'am. In FEMA, as a CS, FEMA regulation is not accepted by the RBI yet for the
Okay.
CS
I
valuer. Yes.
request the participants to share their experiences if all the four methods, whatever Khusbu was highlighting here, anyone has actually applied for RBI FEMA, any questions, any query, any acceptance or rejection has come. I request the participants to, unmute themselves and share their experiences. While we are having this conversation, Kushbu, the third poll question is also a general question. So can
Yes,
we
ma'am.
launch that,
Yes,
Vijaya?
yes, ma'am. Sure, ma'am.
And meanwhile, Harsha, I think Ramani had a query
Okay.
on
Anyone has some experience to
on
share, ma'am?
chat. I think
To say, Harsha ma'am is saying, is it appropriate to seek a penetration pricing for shares? A penetration pricing is normally done for commodity customer products when a newcomer wants to penetrate a saturated market. For shares, it is not recommended, Harsha ma'am. For it's, yes, you are right. It is for the commodity consumer only. Like we can see, we have this grocery segment, Uber, Ola, as I was suggesting, Geo also, but not for shares. Sure. And the poll question is there also.
And
Hello,
the poll question
Nataraj
is
here.
Yes, ma'am. Yes, sir.
Just 1 minute. Just 1
To
minute.
Shilpa's question.
Yes, sir.
Can I go ahead, Shilpa?
No, 1 second, Mr. Natash. The poll question is quite general in nature, and if any other motivation is perceived by the fellow professionals now who are taking this poll, I request you to put it on the chat. And Kushbu, this is a general question, so you had given other options. We couldn't add it here. So I request the participants, any other motivation you perceive for strategic investor, please post it in the chat and Kushbu will take it from the chat. Mr. Nataraj, please go ahead.
Yes.
Yeah. To answering to your question, Shilpa, actually, with respect to FEMA valuation, what regulation says is internationally accepted pricing guidelines. So now, since we are here talking about startup valuation, people use little flexible methods. These are all qualitative methods and invented by various people at various stages, mostly in the US. So I think to my observation also, these qualitative methods are more used in US and in India, maybe in few places only they might be using for startup valuation. That too, I think they will use it for validation purpose, maybe only using that. Only one valuation method may not be appropriate. Now coming back to FEMA, these methods, my personal view is I don't know, these qualitative methods cannot be accepted, cannot be said as internationally accepted pricing guidelines. And FEMA, if it is a startup and then we are getting some money from abroad, then can we use this? Will be the only question which will come. So that needs to be probably thought about. Even then, if it is FEMA, my personal view is I don't think we will go ahead and use any kind of qualitative methods.
So
I
the
have also done many
solution,
startup valuation, but most of the cases I have used DCF only. This method I always read and think about कि I will use in my startup valuation, but I couldn't do it because the Indian scenario is more, or we get the inputs also in from the DCF method only. These methods we have in the theory, it is there ki modern valuation methods, but most of the people are using DCF only.
Yeah, I agree with that. These are all for more of an academic interest.
Yes,
How do
yes.
you know what are the various things and all? Basis this, they arrive at a value, then we go back and work out based on the DCF, which is more like people can understand easily. So okay, if I can take a minute, I'll explain generally how I do when because I'm also an angel investor and I also do a virtual CFO assignments. So most of the time, whenever I build a model and pitch deck and all, even before we even engage with anyone, right? Whether it's a family and friends round or a seed round or a pre-series A or whatever it is. First and foremost, we need to go and have something called like a valuation discovery. Right? Unless you know what is your, even if you go and buy a real estate apartment or something, there is something a base price or something, an expectation. So here also to talk or engage with a prospective investor, whether it's a strategic or is a financial or is for more of a portfolio divestment whatsoever, from the promoter side or whatever it is, there should be something called a valuation discovery. So while these methods all we use at the time of valuation discovery in a way, and plot it on some paper so that we get to something where most of the methods comes to in a synergistic way, not that very way off. So that particular if you plot it on like a football ground from one end to the other end, where you see there are most of the players are in a middle path. So from most of the methods where it gives a middle path, we say we should be somewhere in this path. Basis the timing and the who is the set of investor. So once we agree upon that particular value, then we go back and create the projections accordingly. Because there we get a lot of leg room or headroom, whichever way we put in to work back. Whether to take 5-year Nifty or a 10-year Nifty or a 20-year Nifty, right? What should be the beta? And again, there are various ways we can know whether to give a premium or not to give the liquidity issues, discounts. So those are all the methods where we have. But as a knowledge point, this all will work. If you have nothing, what you will do? But again, we say that we'll give on over a period of 5
There are
years.
some methods also.
Right?
We
We
can use. Yes.
in a day one, there's an idea, right? How do you come to a 5 crore valuation? First, you get to a 5 crore, then you work back and say, these are the next 5 years, this idea will translate into ABC. Whether I put it and sign it for a FEMA or an income tax, I would never say yes.
Yes.
Despite FEMA haven't changed the rule, Income Tax Act has amended in the last 6 months, last October, November, to include rather than NAV or in a discounted cash flow, another all these glorious methods, whatever we see comparable and all. But I doubt, because no matter however you do it, today you go ahead and do it, and the assessment order or notice comes 2 years down the line. And the person who has not even have up to the standard. And even if CA fraternity will not even get to know most of the methods without belittling them or something. So these are all for good for understanding at this point of time.
Yes, sir.
But when it comes to signing off, we generally go by a DCF. Happy to have views here because today I am working on certain client where he is looking for a merger potential acquisition. So he wants to be doubly sure how much I should approach. Whether I'm giving away for free or I am asking for a ransom, he doesn't have any clarity. Okay.
Mr. Srinivas, I have a question for you, a very basic, okay, just wanting to understand. Say, for example, I have a company, you are a strategic investor, Khusbu is a financial investor, normal investor, financial investor, or so what should be my value for you, for her? Because in future, you actually invest, future value is going to be high because you're a strategic investor. Khushbu is coming, she's just a financial investor. My valuation is not tremendously more after 2-3 months. That is about future valuation. All of us are clear. But now, what should be my valuation? For
I
you,
would
for
say
her.
when it comes to strategic investor, because we will also cede away the something called the ownership rights, and he may allow to take the ownership as well. So I may not have much of the thing to like influence or something. So at that time, I'm giving away my rights, not just the ownership, but also the way I would run the company. So at that time, I would have asked for a certain more premium than what I would have given it for for the people who would have like pushed me. They're more like a financial investor. They're looking at another asset class for a diversification. But when it comes to strategic, probably he may give more value as well. But nevertheless, he will be interfering in the day-to-day affairs matters. Right? I may become another employee in my own company. Right? After a certain time, like the Walmart example. 2017-18, they came in, one of the founder is out. Down the line, 4 years, no matter, again, we are not getting into the specific of that. They got into some other mechanism, some issues, they cropped up, and he also had to leave. So that's how it happened. So there is no more like again, slightly again different. No, we have startups now, they are from the day one, they know we are building it for exit, not for owning.
Yes, then the financial investors come.
So they are very clear, the founder as well, and there is something called a builder now, venture builder. This is a new class of like an accelerator is done, angel
Like
investors are
in the
done.
Flipkart case, you say they exited with this and they
So
sold
like
out the
now it's
company.
less than 10-15 years, they are out.
Yes.
Probably what will happen with Paytm is again a story, right? No,
Yes.
maybe the Byju's guy just scraped through. So I'm saying the valuation is again from a different eyes. So I'm saying these are all the various methodologies to discover, and at the same time what we are having it. Like today, if he's Khusbu is there, is more of a financial investor. Srinivas is there, is a strategic, he wants to take it to the next orbit. Then what will happen? The promoter becomes like another employee. And by what I've been observing, the moment the shareholding comes down below 30%, no matter whatever you do, there is no enough skin in the game. Right? At the end of the day, even he is a human being. He is not a machine.
Yes.
So that means that less than 30% would come closer to an IPO or a Series F or a Series C. So obviously, at that time, when somebody is ceding away these rights or something, the valuation would attract a premium or to ceding away the ownership rights to a certain extent. And then the valuation would be obviously higher than what you do at a Series A, Series B, or the person who is coming at that stand at that point of time. Today, why people are doing like now at the early stage of 2021, we were jokingly telling like even at a angel round, we may see a unicorn.
Yes.
Right? It happened as well, right? Kruthring. I think they raised less than 5% and it's a 1 billion wallet. So there's nothing like
How this Facebook acquired WhatsApp. Their
exactly.
valuation. Yeah.
So obviously they are using their mind. So again, I think we digressed a bit. The point is obviously the valuation will change accordingly. And these methods are only to like now we created so much like now once the e-commerce have come into the system and all, we have created so many new KPIs. There was nothing called a gross sales value in the past. Right? Gross merchandise value, sales value, most all these things are new things, right? CAC and all it was not even understood. So today they are developed new more than the way the new business models have emerged. These are also new methodologies how to value. Okay, please continue.
Khusbu, you can take up the poll answer, your viewpoint, and then continue.
Can I see it again, ma'am? The poll answer?
Yeah, is it visible? Actually, for me, it's visible. For others,
No,
is
no,
it
for
visible?
me, it's not, ma'am. You can say, ma'am, the poll question answer.
Yeah, what do you perceive as the primary motivation for strategic investors when engaging in valuation discussions? Long-term growth opportunities, 46%, synergies with existing assets or portfolio, 50%, diversification strategy, 4%.
Two has the same point. Like got the maximum value 40 or 50%. So it is subjective question. Actually, it depends upon the perspective of the investors. It can be first point or second point, depend upon the perspective. So they have given the answer likewise also. So I will continue with my discussion. So first, Chicago is not very used as we see and discussed here also. So in scorecard, another method is scorecard method. In scorecard method, they have certain criteria based upon the impact on the overall success of the subject company. So it is also very subjective. Here we give the scores at two different aspects of the startups, and this method gives the weightage to qualitative aspects like the company management, track record of promoters, competitor, product or service. This leads to weighted average of all the factors based upon their percentage, whatever comes. So if we see there are value drivers like size of the opportunity, how much weightage we are giving. 30% if we give the weightage, the score is 150 and factor will come to 0.45. Intellectual property, if the startup has some IPR with it, some patent registered in their names, with that they can grow in their business and they can have a monopoly in the market. So we can give the weightage to that as well. And what are the strength of the entrepreneurs, the founders, with what strength they have come into this business, and what are the strategic relation, stage of development of the project, fund required. These in scorecard method we give the weightage and then we give the score. So when we give the when we get the factor, we can get the value according to that as per the weighted average value of the company. So if the value of the pre-money startup was 10, then as per this method 1.5 will be multiplied. So it is a multiplier we decide from the scorecard method. It is also not used that widely in Indian concept as we were discussing, but when we can have a second method or for evaluation purpose, if the startup is this, they have these factors and we are giving them the score, what will be the multiplier we can use to get the value. Burkus method. Burkus method is mostly used for the pre-revenue startups, the startups which is not generated revenue till yet. And this Burkus method of valuing startups give values to those elements of progress made by the entrepreneur or team. So this method assigned a range of value as the company begin to make progress. In earlier scorecard method, we were giving scores, and here we have certain values of the company in which we will give our scores or numbers. And Burkus methods works like that. So it is a pre-revenue, and I do not trust on projections, even discounted projection. Dave Burkus has said when the pre-revenue startup, they don't trust on the projection. As the company has not generated any revenue, if we make the projection, it may be wrong, right? So they do not give any emphasis on the projections, even the discounted projections. So Burkus method focuses on these qualitative and quantitative factors to calculate the valuation. Sound idea. This is the basic value. Prototype. What is the prototype of the particular startup? It is reducing any technology risk, quality management team, strategic relationships, product rollout or sell. So these factors we have seen the scorecard also. The factors are almost same, but we are giving values to as per the methods we are considering. So the Burkus method doesn't stop with the qualitative factors. They also assign monetary value to each of them. So just have an example. So like, yes.
When in the Burkus method, when the pre-revenue stage, when there are no projections, with the idea, what is the multiplying factor? How do we get the value? We got all the weights are okay, but what is the value? How do we arrive?
So it's basically assumption, sir. We give the value as per our thoughts only. What value we are giving to particular factor.
No, that is okay. As you know, there is a one value is to come. So value, you have a strong prototype, quality, okay, 20%, 30%. But what is the multiplier factor? Is it 1 crore or 5 crores? How do you, when there is no revenue, when there is no value, how do we arrive the value?
I have also not the practical experience in this Burkus method. Yes.
Okay, thank you.
Yes.
Chandrasekhar, you're talking about the Burkus method, right?
Yeah.
Yes.
Yeah. So here you're saying like whatever we have, say 5 elements.
Yes.
Yeah.
Yeah. Each element is like an $500,000 value.
Sir, what is the $500,000? Why can't it be $2
So
million?
that's the generic, they say what they said in the US, that's how they started. Here we say 500K. That's how it is. Here we say 50 lakhs or 5 crores.
Okay.
So it's like equivalent. No, it's like equivalent of like, whatever happened to if you have to build something for 6 months, so you have to do a technology. So you need 5 to 6 people. So how much is that cost of that particular aspect?
Mm-hmm.
So that's how that 500,000 is given each to that particular line.
Okay.
Okay. So now again that 500,000 maybe in the Barker's time it's maybe like 360, 70s. No, today it may not have anything. So to assign a value of 2.5 million, we are going back whether it can be 2 million or 3 million at max.
Okay. Fine. Fine.
80% to 1.2 points.
Mm.
Okay. So something like method to madness.
Mm.
See to other case studies. First of all, how the Facebook acquired WhatsApp in 2014. So in 2014, you see the giant social media giant Facebook acquired WhatsApp and $19 billion cash and stock. So what are the factors they have seen? So they have seen business support. In that, they have seen the expanding user base. WhatsApp has a good number of user base, as we can see the user base. 160 million users they have when Facebook acquired WhatsApp. And if you give the value to, because Facebook has its own number of users, WhatsApp has more number of users. So Facebook estimated for one user, if we want to create one separate account or if we want to have one person to our Facebook, it would cost us 130 per user. So this value 130 they have given as per their estimate. Am right, Srinivas sir?
Yes, something like that.
Yes. So market price per user, Facebook has determined 130 per user, or now they're acquiring 160 million users to expand their all over database or user base, you can say. So whole figure was coming $21 billion. So in these also, they have given 14.5 billion consideration pays through the Facebook account, Facebook shares they have given. So here we can see the value versus price, how the pricing arrived. They have used this 130 per user and they acquired this, then they have given the shares to them also. Here we can see how the first WhatsApp has given the growth after the acquisition by the Facebook. So we know messages people send per day using WhatsApp by 19 million, voice message also exchanged 200 million, and videos circulated this, and overall number of users came to 450 million after year 4 of the acquisition. So it is a case of pure strategic investors, not from India, but from US. They have given this how this all the concept of corporate finance and principle of equity valuation. Facebook acquired WhatsApp as a very bigger valuation figure. So they have expanded their user base. They have monetized the opportunities to see a long-term monetization profit, large user base, engaged community of users. Overall, it was a strategic vision. Facebook acquisition of WhatsApp shows the importance of having clear vision and long-term goal when investing in startup. Why aligning this acquisition? It's a core business goal. Strategic investors always have a core business goals, and Facebook through this acquisition expand WhatsApp potential and create significant benefits of both the companies. Overall, Facebook acquisition of WhatsApp is an example of investing in good companies and highlight the importance of joint venture, application focus, ecosystem, integration in driving growth, innovation, competitive advantage. By buying ideas, companies can expand their business reach new audience, take advantage of new trends and opportunities in the larger market.
To modify your formulas input to estimate sales revenue and cost. You can also model systems that uses random events such as product demand to estimate the resource utilization.
I can see anyone giving their hello. Okay. So we can see in Facebook WhatsApp acquisition, what are the factors they have seen? WhatsApp will acquire, they have acquired the WhatsApp, and through this they have a vision, they will monetize in the future sales. Now we can see WhatsApp, Facebook have this ad feature also. So at that time they have acquired, they have not thought about immediate monetary returns. Now they are generating the returns through this Facebook, WhatsApp ads. So it is purely a strategic investment example. We can also see what factors. Scalability, we were saying one of the factor. So in scalability, market size, market share, and team and timing of the market also matter. The bigger the market you are entering, the bigger would be the valuation and the more attractive the startup investment. If you see serviceable obtainable market, it's a market where you are going to reach in the nearest time. Serviceable available market is the reachable market which we have the focus in mind and which is reachable, and the total addressable market is the whole market with all the participants in your reach. So when the startups come with the scalability thing, they see these three factors. We'll see example of Bird. Bird is the fastest startup ever to reach 1 million valuation. Environment friendly micro mobility platform. It was for everyone to become a unicorn in 1.25 years. It has become a unicorn only in 1.25 years from the day it was founded. So what was the problem statement they have used? What are we are using 2 tons of metal to move 70 kgs bodies around, while something that weighs 16 kg like a e-scooter can do the job as well. And why are we giving away so much space in cities to cars? So it was a problem statement that e-scooters can have the less space and the good number of movement also. It will show about how we travel. So solution was tech-enabled lightweight electric vehicles readily available to rent or own around the world. So Bird, with this concept, they have raised the valuation. It is the fastest growing unicorn also. It's a pure example of scalability. Another example is Ease My Trip. It's an Indian company. So it has its IPO price was 187 and the post-bid is what trading at 50. Market capitalization was then 8,810 crores. Price to sales ratio, if you see, it was 16.63 and an IPO time price ratio was 15.773. It has shown an year-on-year growth from September 22 to 23, 1.5x, and year-on quarterly growth have seen 0.20x. So Eat My Trip has acquired Spree Hospitality and Travelet. The acquisition of these two startups expand the company footprint in hotel and hospitality segment and B2B travel marketplace respectively. It was purely a case of strategic investor when one travel company has acquired another travel company to expand its user base, use their technology, and company has, with this acquisition also, company has seen the growth. The company recorded year-on-year growth, as we can see. They have reached the total target of total sales of 120 crore and 1.5x increase compared to 104 crore in quarter 2 of 2022. Depending on discounts and increasing ticket prices are two major short-term threats to the business of Ease My Trip in the coming financial year. They are also growing, but they have these because they depend more on the discount and increased ticket prices. It is their threat. So Ease My Trip is a profitable startup. It is a startup which is profitable. We have mostly seen the startups which are bearing loss. We can see those Paytm loss, Zomato loss. But Ease My Trip, with their strategic investment, they have made profitable startup with a profitability of 51 crore in quarter 2. Stock performance also, you can see Ease My Trip valuation has increased by 279% from its IPO to a market capitalization of 8.81 thousand crore. So when the strategic valuation is also done, these factors come into play about the growth of the particular business we are acquiring and the multiples, revenue multiples, growth, PV by PV ratio, EBITDA multiples. And if strategic investment is done in a very good way, we can see the Ease My Trip, how it has increased its price from the IPO. Financial performance, you can see also. They have this operating revenue in blue, we can see operating expenditure in orange. So you can see operating revenue is growing faster than the expenses. So company has come into green. Upward trade evident in the EMT sales growth in the past quarters. We can see the sales growth. EMT recorded average quarterly revenue, we can see 14% from 2021 to 2023, and expenditure also behind sales. So they are having good sales and less expenditure. Key performance indicators, here we can see they have 14 million registered customers and they have over 60K registered travel agents. Social media reach also, they have good numbers. Booking success rate, look to book ratio, operating profit margin. So these factors are very important when we are doing the valuation of these type of companies. We have to see what kind of companies we are valuing, what are the factors that impact the companies. As for the Ease My Trip, it's a travel company, they books out trips. So for them, customers is the king. So if they don't have the very good number of registered customer, they won't grow. So after that, the Ease My Trip, we can see the 14 million registered customers they have grown. They have 60K registered travel agents also. These factors in this business, we can use this kind of methods because the company is generating revenue. They have all the variables which we require in the scorecard method and all. We can also discuss Tata acquisition of Big Basket. It was also a strategic investment. Tata Sons, the parent company of Tata Group conglomerate, made a significant strategic investment in Big Basket, in India's leading online grocery platform. The move was not just acquiring a stake in the growing company, but rather a key element in the Tata larger digital ambitions. Tata initially acquired majority stake, 64% in the Big Basket for 9,500 crore, approximately $1.3 billion, 2021. Since then, Tata Digital further invested in the Big Basket, totaling 550 million in investments. So Tata, we know it's a big conglomerate, it's a FMCG segment they have, but they don't have still now the grocery online business that comes with the e-commerce. They have this technology. Big Basket has name, it has a user base also. So Tata joined hands with it and acquired it. So here the factors they have considered: independent brand strategy. Despite the investment, Big Basket currently operates as a separate brand with Tata ecosystem. They do not merge the brand. The individual identity still remains. This might change the future as the super app vision takes shape. So when this Big Basket app, if you see, it's written Tata Enterprise, but it has its own separate brand. Profitability concerns, if you say, Big Basket has not yet achieved profitability, which is common challenge in the online grocery space. Integrating Big Basket with Tata existing business might help optimize operations and potentially lead to a faster path of profitability. So in the short term, if you see, Big Basket has not done very good in terms of profitability, but if you see the future, it may happen they can optimize their operations and they can come in the green and they can get the profitability with this vision. What the Big Basket is having, it's a super app dream, a work in progress. They want to create an app in which you can get all kinds of grocery or all kinds of food. They are building one super app that is very ambitious and strong. It will make a strong foundation for grocery segment, and integrating various across the Tata conglomerate into a single platform will be complex. Understanding and success of model will depend upon it. So it has a backing of Tata name. If the app is not performing well, it will make an impact on the brand name also. So they have a good stake in this thing, and they want this success of the model, and it all depends on the performance of this particular app. If you see the user interface and experience, creating an intuitive and user-friendly interface allows for an easy navigation between different services within the app will be critical for user adoption. If they make the app very critical in switching or something, it will make it very difficult. Data security and privacy, building trust with user by ensuring robust data security measures and transparent private practices will be of paramount value proposition. The super app needs to offer clear benefits and incentive to users to encourage them to switch and consolidate their online activity with the Tata ecosystem. So Tata investment in Big Basket is a strategic move with the potential to redefine Indian online retail landscape. Whether the Super A's vision materializes or how effectively Big Basket is integrated with the Tata ecosystem remain to be seen. However, this partnership undoubtedly marks a significant development in the Indian e-commerce space, and its success will closely watched by the industry players and consumers alike. Ma'am, we can float the fifth question. Vijay, ma'am?
Khusbu, I didn't get you. Are you waiting for Vijaya for anything?
Yeah, question, ma'am. Please float if you have a question. Four
Vijaya,
questions. Yeah.
I think Vijaya is not there. Poll question has to be launched?
Yes, ma'am.
I think she's not there. Just give me 1 minute. I'll just
Okay,
launch the
ma'am.
poll. Give me 1 minute. You continue the
Anyone
discussion. Just give me 1 minute.
to say something on this Tata acquisition of Big Basket? Anyone worked upon any of these assignments?
No. Anyway, these are all doesn't come to people like you and me. This will all go to some of the
Yes,
big
sir,
fours.
actually. We are just studying them and giving our opinion kind of thing.
Yeah. So typically, in fact, they have their own in-house team. So typically, we may not even come closer.
We can
Most
see,
of the
sir,
time.
how these valuations are done. We just analyze them.
Exactly. So this is more for an information, and probably we can suggest to the budding guys how you have to look at to.
Yes, yes. Ma'am, poll questions, are you floating, ma'am?
Okay.
So there are many examples of though there are most of the startups investments are done by the financial investors, but we can also see cases of this financial investment as well. Adani has also done investments like this. And we can also say Google and YouTube. When Google has invested in YouTube, it was also purely a case of strategic investors. And the valuation, if you see from the valuation point of view, the valuation will more depend upon the multiples, and we will surely use our DCF method only. But these factors which I was discussing, the pricing factors, the other factors, it will have a huge role on using the multiples and choosing the multiples from the peer companies as well. So the poll for question is here. In your opinion, what factors differentiate strategic investors from the traditional financial investors in the valuation process? A very simple question.
Actually, again, I think it should have been a multiple choice and not a single choice. I have given a single choice, but
Valuation is not a max, right? Valuation is not a max to get only one answer. It has got multiple answers.
Valuation is an art, as we have studied also. Different valuers, if we value the same project, multiple value can come. It is based on the assumptions mostly.
The question can be read as, what is a major factor differentiating strategic investor from traditional financial investors? The major or dominating or the first point.
Can you see the answers, ma'am?
Yeah, I'm ending the poll now.
Yeah, ma'am.
Yeah, since people were voting, it's done. I'll share. Yeah, can you see the results, Khusbu?
Yes, yes. Most of them has voted for this long-term strategic alignment that differentiate from the financial investors. 53% has voted for this, and 30% has voted for access to unique resources and capabilities, and only 17% voted for industry enterprise. See, the strategic investor, financial investor, these 3 points are very important. But yes, long-term strategic alignment is the biggest thing which differentiate from financial investors. And resources, industry expertise, it will still be there, but they always have a long-term vision from a strategic investment point of view.
So, my question to you and to the participants also. So, for founder, I have a founder's agreement. For SHA, I define all the, most of it is rights of the, investors. Okay. So when it comes to responsibilities of the investor, we just have, maybe tranche 1, tranche 2, certain kind of investments. Whether SHA is the document, because, somewhere strategic investment, there is a responsibility also. Whereas an investor doesn't have only rights and not responsibilities. So is SHA the document where I give some milestones or something, or suppose I feel, some Mr. X is going to the strategy investor, I have certain, conversations, certain milestones or whatever. It could be marketing, it could be connects, it could be anything, strategy, vision, anything, and it's not happening. I'm just taking a very practical perspective. Okay. He behaves like a financial investor and my goals are not achieved. So anyone has had any practice, because all of this is more relevant maybe after 4 or 5 years. Now we invite a strategic investor, we wait 1 year, 2 year, 3 year, nothing is happening. And where do I fall? Which agreement? Should I have some investor agreement separately? Can I put that in SHA, where normally SHA is one single document where all my other financial investors are there? I don't even know, what is the name. Even though you're company secretary, I am company secretary, whether any agreement like investor agreement is entered into with the strategic investor to make him realize. So, maybe something like a clawback. Clawback is usually done, founder takes it back. So can I have a clawback clause for the strategic investor? Because I'm putting him reliance, I'm giving him certain things. And if he doesn't achieve, maybe I'm thinking loud, for the benefit of, all of us, because few of us are CA also, CS also, not from valuation perspective, but from our other profession. Maybe, a strategic investor, a clawback clause can be attributed, aligning it to the responsibilities what he has. Otherwise, there is no difference, no, other than the financial investor and strategic investor, the responsibilities what is on him. Ultimately, it has to be measurable, whatever said and done. These days,
yeah, I want to add here, the moment you do something in arrangement with a strategy, then it can be, I will not say as an, or potentially misread as like minority shareholders, and which is like gaining a lot of issues, right? No matter what it is, like we saw it in Adani's issues and in the various parts, right? The moment you do something with one set of investor who has got a much more stake in the game, or he's got much more in a way, not just the financial investment, he's investing his time, effort, everything, right? To getting in the business connects and all. So I would what the classic issue is the indigo promoters who got almost on the pair, but again they fallen apart despite being a good friends and all. So no matter however we write, is the spirit is more important when you have to work. But coming specifically to that, if you want to have another arrangement or an agreement, whatever name we give it, it can't work again, because it will be construed as like you're taking away the rights of the minority shareholders. And so whatever get applied to him, that should same get applied to the minority shareholders, despite not being participating. So in that approach, whenever, in most of the time, what happen is when somebody of that nature comes in, the cap table get cleaned up. So that these guys becomes like a more of a GV partners. From though the private limited company may exist, then it becomes like a lot of a JV aspects, and where they define those responsibilities, rules, and everything. And most of the time, what the Kedara captain does, sorry if I'm not still taking the name, they're very clear. They put the money, they don't run the company, they may seek certain board positions, but they influence the decision making,
Yes.
right? When I say influence the decision making, they try and appoint a CFO, they try and appoint a group CEO or somebody who is, and the promoter is still there as a chairman, managing director, and all. And at they help them out in scale, helping and all. And subsequently, they take an exit through an IPO route. They are always like a strategic investor, they'll add their value, but they not run the company in a per se, like from a board perspective or a day-to-day affairs, they'll not become an individual, they'll not get into a board positions or something. So they'll appoint an individual to safeguard their interest. Because they also understand the moment board, no matter whatever we write in the shareholder agreements or you come up with a new agreement, it's practically is not so possible to implement on the ground. So better is seek positions where they can make an impact and come out of their safeguarding their investments. In the process, they may given a better it's in the financial market. You should never see what other guy has made money. You should always think what you have made money. Otherwise, you'll never be happy. Right?
Yes, yes.
The rule of equity, the way it works, right? Be sure that as long as whatever you asked for, you got it or not. In the process, if somebody has gained, let be it. So they are very clear on that aspect. So that's all. Again, otherwise you keep writing as many arrangements, as many agreements, till then it becomes not enforceable. Like the classic case of Tata Docomo,
Yes.
early 2011, right? They wrote something despite being a groups of a Tatas, right? It hit a regulatory roadblock. So which is the challenge? Today, India is a country where there is huge legislation, less on execution. We can't even know what all we get complied with or where we should be compliant. Because nobody knows that what all acts applies to us in total. Nobody can say with putting his hand on his heart that I have complied with all the known in letter and spirit. Because he doesn't know what all he has been should be complied with in the first place. So how he can say? So that's the reason. At the end of the day, the spirit takes more important and how that is being enforced. If you have multiple arrangements also, I don't see it can be of any help. Better to clean away the cap table, get closer guys at a certain level of synergy levels or in equipment or where they have a wavelength and work on those specific issues, clauses. What will happen by when and what will happen in case it is not that, then those are like a standard. Now it become like a norm. Drag along and all that, right? So clawback, how we will protect, what will happen if the qualifying round does not happen, say in 3 years' time. And most of the time the owner has nothing, the promoter has to pay back or clawback and buy back. Okay, thanks.
Yeah, are you there? Can you hear me?
Yeah, can you?
Yes, ma'am.
Vijaya, can you
Yeah,
launch the fifth poll question? I am unable to launch.
Yeah,
Kushbu,
ma'am.
that is also general question. I'll just see.
Yeah, Harsha ma'am was saying we can only imagine what Tatas must have thought while buying Big Basket. So many synergetic aspects are hard to understand as an outsider. Same with Facebook buying WhatsApp. Investors have a bigger vision, understanding of how they would leverage the investment. It is very right, ma'am, that we can only analyze these things. As sir was saying, this kind of assignments doesn't come in our hand. We only later on we finalize and we think of factors they must have considered for looking towards this investment. And on similar line, Harsha ma'am said, how do we issue advisory shares where shares are to be issued without any monetary consideration? Srinivas sir, you want to say something on this regarding advisory shares issue?
This advisory share issue is more practical issue. Okay.
Yes.
But what happens is we get stuck in the Companies Act. As you are also company secretary, you are aware of it. How to give advisory? No consideration is actually not permitted.
It's kind of swap ratio. I think the advisory says when we give to them, it's like
It's more of a sorry. Okay.
Yes.
Sorry for the it's more of a what you call is like a barter deal. Like what times grow. See, most of the startups by general what happens, they need to be more like no, they have huge budgets for the marketing, right? The full page. And Hindustan Times, which Times Group's own Bennett Coleman, BCCL. So they have no choice because the guys who it is whether they come through media or their own or through an agencies. No, they end up like landing up say Times Group. So Times Group, what they did is like a strategic move. They take only a 30-40% of the amount what they generally incur as a startup as a cash. When I say cash, as a payout, and the remaining all is a deferred. It's like a credit line. That credit line gets adjusted for a share issue at a later date. So for them, it's simple. Whatever they are incurring the cost for that particular event or that particular page ad or whatsoever, they are getting that much equal. So the profits are getting plowed into a later part.
Yes.
So in this similar is a case with for an advisory shares as well. Like today I am helping somebody, like it could be you are helping, or say Pradeep is helping, or whoever is helping, restructuring and all. So rather than he raise the money and give it to you, he says it's like another way of ESOP. So since it is a private limited company, or there are some, like, if you're not a shareholder, if you're not an employee, you can't get any ESOP. They come up with a term called an advisory. So you raise a bill accordingly over a period of say 1-2 years whatsoever, equivalent of your service fees. Then they say whatever is the valuation agreed. There's always a monetary consideration. There's nothing called without a non-monetary. So it's only like you are deferring the payout and later you're taking the shares equivalent of that. Or sometimes what happens, the promoter pays it, but that's not a good practice because promoter is different, company is different. Unless you have some arrangement or any other viewpoint on the advisory.
Here comes our poll question. How do you think strategic investors assess the value of intangible assets compared to the financial investors?
And this is the last poll question.
Yes. Intangible assets, we know all the IPR, patents. This comes under this category. This play a very important role when we are acquiring a company which is based on technology, software license. They have something very good. So there is a lot of emphasis on the intangible assets and which makes their brand value later on. There is a company I was valuing. The startup is based on, like, they have an idea that this COVID kit we have. In that COVID kit, we can get the test only for COVID. So they are developing only one kit in which you can get all the tests done. So you buy the kit from the market and you get all the tests done at your home with the single tick. So it's a basically biotech company. I was doing this valuation like two years back, in which in there at that time they only have this patent about this their prototype which they have made. So it was a biotech company. And recently, Triple IT, one of the premier IT institute, they have invested in this project. The founder has a vision, and he himself is a technological guy. So he knows and he has some experience in this biotech industry also. So based upon that patent, about his valuation differs. I have done the DCF. I have used with the DCF method only, but the factors which I have used, because he has patent in that, we know the relief from royalty which comes when they have something patent like this. In that also we have used the DCF method. Then we have taken the patent, without patent, with patent, what is the valuation is coming. So strategic investors, when they invest in these kind of projects, when there is intangible assets involved, so it differs. It takes the valuation whole around. As most of the participants have given the answer, they place more emphasis on the intangible assets. Yes, it is correct answer. They put more emphasis because the overall valuation will change as per the intangible assets involved.
In
But
fact,
Khusbu,
okay,
Yes.
sorry, ma'am. Just give me a second, ma'am. In fact, there is a firm, I'm not able to recollect the name, in US which specializes in IP valuation.
Yes, yes.
So when I get an access, I will share it with you. And it's like our LIC actuarial valuation, how it differs from our valuation, right? Even it's
Yes,
not
yes.
that simple, it's just more statistical and all factors, right? So similarly for IP valuation, which is that is the core of this, right? If somebody has to like AWS, why it's so expensive or how the value is derived from this, it is very complex. All that we understand is only simple things like, oh, how many lines of code has been created. And that's one numeric number we think. But the thing more also is like, if you look at Amazon, everything happens in 2-3 clicks.
Yes.
Why Tata app is failing today is because that's not so easy still. Despite it's a super app, you can't even place order in three clicks or 4 clicks.
Yes.
And there is a huge workaround for if you have to go by a Tata 1 mg is different. Then there is a like if you have to place order on for grocery is different. So
That's
despite
why
that,
they want to, sir, develop the super app in which you will get everything.
I'm saying why still it is not hitting the roof or streets or anything, why people are not downloading it, even if somebody is downloading, why they're not using or they're uninstalling is that the thing. See, one is the
Yes.
UI UX and the ease of that using. The benchmark is within 3 to 4 seconds, are you able to place an order?
Yes.
Until then, no matter whatever you see, people see again, it's a cruel world. People pay for the results, not for the efforts.
People doesn't have patience also. They want to have a place
Patience
and
तो है ही
order.
नहीं.
Yeah.
Patience तो है ही नहीं. He'll not even look at what has gone in. He'll say what has come out. Because he's right? He's a customer, he's paying for a convenience.
Yes.
So he says, I am not here to look at your efforts. So efforts का क्या मतलब है unless it doesn't result into some tangible thing, right? So similarly here, if he goes on saying that I prepared for 10 hours, 18 hours, 20 hours, but if you don't perform in the 3 hours exam, what is it? So similar is the case here. So even with the naked eye, we can't do this. So this is a specialized aspect. How did he file those patents, how it has got an IPR, and how far they can have, if somebody can question those, challenge those. So these are also that itself, and that's the biggest asset somebody like for a startup is the intangible asset.
Yes.
Today we call it as a platform, marketplace, but that's not so easy. Okay, sorry, ma'am, you're saying something, Vijana.
Yes, ma'am.
Actually, Khusbu,
Yes, ma'am.
when a startup valuation is done, okay, and there might be intangibles definitely, and as normally accepted DCF method is used, so automatically the value of intangibles is considered in all the increased cash flows, be it top line or a better expense or a better working capital cycle. How do you do actually, say, considering there is a strategic investor, there is a startup, there is a lot of intangibles, what method do you follow for ultimately it's a business valuation what we are expected to do in this startup scenario when strategic investors are coming? So how do you account this?
Because in this case, if you're saying every value is incorporated in the factors only, so we go either with or without method. If we are using that brand name, how much revenue is coming, what is our capital expenditure, what we are paying for that. Without method is the variant of income approach. We can use that kind of method also. The traditional method we are using, but with a different perspective, approaches to valuation.
No, we don't want intangible valuation. We want business valuation considering there are intangibles.
So business valuation we will do. We will use the DCF method, but without method we will use. What are the we have to particular in the case of intangible or business valuation, the particular brand is valued. Those who done the service saying the IPR valuation, though they only value the brand. And practically I have not valued this personal brand or patent like that. So they value the brand, then they incorporate the brand value to the DCF existing DCF, and without that and with that, they do the valuation, then they compare and find out the common value which comes.
Can I add something?
Yes, sir.
Yeah. So, ma'am, what she's trying to say is, or generally how anybody approaches is, you have something called intangible. It may not reflect on your fixed assets, or most of the startups write off this platform expenditure because as an accounting standard or even the strategic investor doesn't look at what's there in your balance sheet. It's more to do with the cash flow. Okay. So even accounting to certain extent, like, to show off the better net worth, people may capitalize, but when it comes to decision making, nobody puts a value in standalone basis. What's been on the Schedule 6 format. More importantly, they say, or they look at, what does this realize into my cash flows in the future? Like Zomato, when they came in for an IPO, even our great, when I say great, not in any, Ashwath Damodar, right?
Yeah.
He said, we can't give more than 35 or 40 bucks to Zomato valuation when there was everything was at peaks, right? And he was being like trolled like anything when it got at when the offer price was decided at 65 and then get listed eventually higher, went up to 3 digits and then it came back less than 100. And when Paytm was did an IPO at 2150. So the long point short is, you can't directly put an intangible value to your strategic value or a business value. What does it relate to, or what does it translate to your cash flow? What it can get you into the service delivery aspects, how it can make easier. Like the same example of Zomato, right? Even before Zomato was there, parcel delivery was there, but that was very, very, very fragmented, right? And it was not at all there was no digital leg to it. When you say digital leg, you don't know where your food is, who is going to pick up, right? If you want to give instructions, whom do you call up, or when he is coming, there was no traceability of your order. All that Zomato did was took the same business line, added the convenience factor and other data points. So, which is where they created value. Know that what they have done, they're not that they have put in a multiple numbers than what it was like a delivery partners. Probably the same delivery partner being used for multiple restaurants, but otherwise they're largely the same people in the ecosystem. Okay, restaurant was available, consumer was there, the delivery partner. All the three were available in the previous day. Also, they took the what we call it as join the ecosystem and enhance the ecosystem.
Yes.
Right. So that how is that happened? Because of their entire like in a, what we call like in airports, right? The control tower. Similar to that, they built where each one get their value out of it to the next level. So what that is an intangible asset, the platform. Because of that platform, they are able to do now millions of orders, which is getting into their cash flows, indirectly into P&L, then into cash flow, which is helping them drive the valuation.
So
And
it is hard to
whether,
separate it, sir. Like when it is the tangible asset, you are saying it is putting the value in that. So it is very hard to separate.
of course, because it becomes very difficult in the
Yes.
sense, all that you will have the cost taken to build that.
Huh.
Like you will say that I have over a period of time, I have put 100 technocrats or techies. I have spent 10 years of time and have paid this much of salaries and this much of other expenditure, but that's only a cost part of it.
Yes.
But that's not the monetization does not come in. Or somebody is there who can directly put a value and pick it up, that's a different.
Yes.
But again, it is again at the cost of what he can pay. Whether it is a right, wrong, nobody can question.
Yeah, it's based
Because,
upon the assumption only.
because like the why gold has its own interest, nobody can question the gold value, right? Because there is no production value or something like a fuel. So more of an intrinsic value and what it can cater.
Demand
But
and
that's not,
supply matter, sir.
sorry?
Demand and supply matter here.
No, not demand and supply. The thing is, it is not a knowledgeable where two people have got the same set of knowledge to value that particular. Today you take in a refrigerator, everybody knows what goes in.
Yes.
They can value it. Maybe with around a 5 to 10% differentiation because of the what sort of condenser you use, what type of material you use, sort of. Because largely it's a commodities. But when it comes to this asset and all, which is an intangible, very difficult. What you still go and get to know is only the cost part of it. That is also very varies.
What
Today
are
you
the
never know
efforts
whether
or
he has put.
time we
Yeah.
have invested in developing the
Exactly.
particular?
So you whether you put in a guy from an IIT or you guy put in from a next door engineering college. So that's the reason intangible is very difficult to value. All that we know is how to value is like an indirectly. what does it give you what it adds to your bottom line? Again, if it is used in India, it's a different. When you take it, that when you transfer the model is a globally is very different.
The factors which affect this particular intangible asset that matter if you go around the world.
Exactly. So how important, how you can monetize. So which is where we say the scalability and all, which indirectly gets it.
Yes, yes.
Otherwise, what will happen to do after it hits the maturity? We instead of doing a perpetual valuation, we need to say that we are giving away this company, this platform. Somebody is putting a big value. Indirectly, he'll also come back to this value only.
It will come down eventually.
Eventually. So whether somebody is buying out that particular asset, also value the asset based on this future cash flow.
Yes.
So intangible as a per se, it's always indirectly. It's not something like a real estate I'll add as a separate to the business valuation and say that is an entire enterprise value, which is very difficult.
Yes.
Okay, I think we are done.
Yes, yes. From the valuation point of view, as we are discussing, the same methods also apply for startup valuation. Just it is the case that for in case of strategic investments perspective, if you say we focus more on the factors existing in the company and the motive of the strategic investor. We have to know the strategic investor point of view, what is his vision towards the company and what he is seeing in the company. Accordingly, the value of the company may come little lower if we do the valuation for this.
Go up
Yes.
as well. Like I'll give you the same example of Flipkart. Okay.
Yes.
When Walmart applied, all
Hmm.
that they had is stores in US, right? They had their own number of stores. They were looking for a backend. So they can't directly put up a channel in India to source from here and to export it to for the in US to sell.
Yes.
What they figured it out, ecosystem is entirely built by Flipkart. So while they sell it in through Flipkart in India, they are getting access to the entire ecosystem of their supply chain, which potentially can help them to source for their global operation. So they were ready to put a higher value.
It depends. So some may have a higher valuation, some may have a lower valuation. So valuation is yes.
Instead of Walmart, in
Yes.
the example where I gave, if you had a Kedara invested in Flipkart. So in this 5-year period, Kedara would have looked at for an IPO to the Flipkart and they would have encashed their stake.
Yes.
So this was because the Kedara can't run the business. Kedara can be a strategic investor in a way to enhance the value by adding financial muscle. Whereas for Walmart, it is their bread and butter. Why Vodafone India has acquired Idea or they joined hands with Idea? Because they have been a
Same
global
line of business. They are running the same line of business. They are
So they are a
expanding
global
their
business in
business.
that line. So even 2-3 billion down the line draining in India doesn't because they are getting 100 million customer like easier, which is to get 100 million customers in rest of the world is very next to impossible.
In India, they are getting it very
Much
easy.
easier.
Yeah.
So even the same example like Facebook and WhatsApp.
WhatsApp, yeah, it's the
For
same
you-
example.
For
Yeah.
user. So they're saying 100 million users. So even if you put $1 or $2, it itself
They
will
have
be
to
like
spend
$10.
very more. Like 130, they have
Then
put
it's
the
a
figure.
billion
Yes.
valuation.
Yes, yes.
So that's how they look at. So whereas various partners, these are all strategic. They're not financial anymore. They're all strategic. They want to bring value to the table and they want to work closely. And how they want to take the exit is a question.